Welcome back, everyone. We're diving into some pretty interesting stuff today. Leveraged ETFs and barbell strategies. We've got some really cool research from East Tennessee State University, and I think it's going to change how we think about risk and reward.
Yeah, this research is super fascinating. We're going to break it down for you so you can walk away understanding not just what these strategies are, but how they actually work based on real data.
Okay, so before we get too deep into it, can you just quickly explain ETFs and leveraged ETFs? Just to make sure we're all starting on the same page.
Absolutely. So an ETF, or exchange traded fund, is basically a basket of securities you can trade, just like a stock. They're designed to track a specific index, like the S&P 500. So if you buy an ETF that tracks that, you're invested in all 500 companies.
Got it. One-stop shopping for a diversified portfolio.
Exactly. Now, leveraged ETFs, those are a little different. They aim to amplify those daily returns, sometimes double or even triple the index's movement. That's the leverage part.
Okay, so potentially double the returns. Sounds pretty good.
Yeah.
But I'm guessing there's a catch.
There is. The leverage works both ways. It can magnify gains, but it can also magnify losses. And then there's this thing called decay, which can really eat into your returns over time, especially in volatile markets.
Decay. Can you explain that a little more?
Imagine the market goes down 5% one day, then up 20% the next. A regular index, you'd end up with a gain, right? But because of how leveraged ETFs are calculated daily, you might not actually see that full 2x or 3x gain you were hoping for.
Okay, so more risk, but also more potential reward. And that leads us to barbell strategies, which are all about finding that balance, right?
Exactly. A barbell strategy is all about spreading your risk. You have one side heavily weighted with safe investments like bonds, your low-risk part. And then on the other side, you have a smaller portion allocated to higher risk, higher growth investments. And that's where those leveraged ETFs might come in.
So kind of like the classic 60-40 portfolio, but with a little bit more of a thrill-seeking side.
Yeah, that's a good way to put it. And the research we're looking at today, they actually explored using options on those leveraged ETFs within a barbell strategy to see if that could give you even more protection, maybe even more potential for gains.
Interesting. So what did they find? Did it work?
Well, not really. Adding those options didn't really work out the way they expected.
Why not? That seems kind of counterintuitive.
Yeah, it's kind of surprising. They found that the cost of buying those options actually outweighed any potential benefits. So instead of boosting returns, the options ended up dragging them down.
So even though leveraged ETFs seem like a natural fit for a barbell strategy, adding options to the mix might not be the best move.
That's what the research suggests, at least for the period they analyzed. But here's the interesting thing. They did find that just using leveraged ETFs on their own, without the options, actually outperformed the underlying indexes when it came to returns.
So higher returns, but higher risk as well. It's all about that balance, right?
Yeah.
But I'm curious, did the researchers come up with any other approaches that performed well?
They did, and this is where it gets really interesting. They tested out combining a risk-free asset, in this case bonds, specifically IEF as a proxy directly with leveraged ETFs, and they called those weighted portfolios. Basically, it's a simpler approach. You skip the options, just allocate specific percentages to each asset.
Okay, so no complicated options, just a blend of safe and, well, less safe assets. What did these weighted portfolios actually look like?
They tested a few different combinations. One portfolio had 50% SSO, a 2x S&P 500 leveraged ETF, and 50% IEF, the bond fund. Another one had 33.33% UPRO, a 3x S&P 500 leveraged ETF, with the other 66.66% in IEF. They also looked at similar combinations using leveraged ETFs that track the NASDAQ 100, like QLD and TQQQ.
So basically, they played around with different ratios to see what worked best.
Yeah.
How did these weighted portfolios compare to those barbell strategies that used options?
They actually did better. The weighted portfolio showed better average returns overall, less volatility, and a lower potential for big losses.
Wow, so a simpler approach actually led to better results. I have to admit, I didn't see that coming. But I'm sure you'd agree, any investment strategy needs to be tested right.
Yeah.
Especially with how unpredictable the market can be.
Absolutely. And that's where they really put these strategies to the test. They wanted to see how they would perform during a major market shock. So they looked at the corona crash of 2020.
Oh, wow, the corona crash. Talk about a wild ride. So how did those strategies hold up during all that volatility?
It's actually pretty interesting. During the crash itself, the barbell strategies, especially the ones using just the plain index, not the leveraged one, they actually offered better protection than the weighted portfolios.
Really? That's kind of surprising, especially considering what we just learned about their overall performance.
Yeah, it might seem counterintuitive, but it just goes to show that different market conditions can lead to very different outcomes. It really highlights that there's no one-size-fits-all answer when it comes to investing. Each strategy has its own strengths and weaknesses. What works best depends on you, your risk tolerance, how long you're investing for, and what you think the market's going to do.
So if I'm thinking about using one of these strategies, I can't just blindly follow what worked in the past, right? I have to think about the current interest rate environment and how it might affect things.
Exactly. And remember, this research was done during a period of historically low interest rates. So the findings might not translate directly to today's environment. That's why you have to really think critically about how these strategies might perform under different market conditions.
So things are a little more complicated now that interest rates are rising.
Definitely something to keep in mind. And don't forget, this research only looked at a specific set of leveraged ETFs and indexes. There are tons of other options out there, each with their own risks and potential returns. You really have to do your homework.
Got it. No shortcuts when it comes to investing. But I have to say, as we're talking about all this, I'm starting to see how these strategies can actually be broken down into manageable pieces. It's all about understanding the underlying principles.
That's the power of knowledge, right? It helps you take control of your finances and make smart decisions. What stands out to you as the most important takeaway from all this?
What really struck me is that even these complex strategies, like using options on leveraged ETFs, don't always work out the way you'd expect. It's a good reminder that there's no magic formula when it comes to investing.
I completely agree. There's no magic formula, and the markets are always changing. That's why it's so important to stay informed and be willing to adapt. While the researchers in this study focused on certain strategies in a particular time frame, the principles they uncovered apply to every investor.
This deep dive has been really insightful. I feel like I have a much better understanding of leveraged ETFs, barbell strategies, and how important careful planning is.